Here is an uncomfortable truth. Almost any trader can learn to draw a fair value gap in about 10 seconds. 3 candles, a bit of space between the wicks, done. And almost all of them still lose money on it. The pattern is the easy part. The filter you wrap around that pattern is what decides whether the gap pays you or quietly eats your stop loss. In the next 12 minutes, I'm going to hand you that filter. By the end of this video, you'll be able to do 4 things. Spot a valid gap, including the one common formation where the 3-candle rule quietly gives you the wrong zone. Explain exactly why price keeps coming back to it. Read the reaction when price finally arrives. And apply 4 hard rules that delete most of the bad gaps from your chart before you ever risk a single pound. Stay with me to the end, because rule number 2 is the one that fixes most people's win rate on its own. Part 1. The 2 forces behind every move. Before we touch a single candle, you need the bigger picture, because a fair value gap on its own means nothing. Price is pushed around by 2 forces, and everything else is decoration. The first is liquidity. The market needs orders on the other side to fill size, so it hunts the places where orders are stacked above old highs, below old lows, under obvious support. That's not a conspiracy. It's just plumbing. Big participants go where the fuel is. The second force is imbalance, and that's where our gap lives. When price moves so fast in one direction that one side barely gets to trade, it leaves a slice of the chart where the auction never really happened. The market treats that slice as unfinished business. Put the 2 forces together, and you get the rhythm you see all day long. Price sweeps a pool of liquidity, then rotates back to rebalance a gap, then uses that rebalance as a launch pad for the next leg. Sweep, fill, continue. Once you see that loop, you cannot unsee it. Part 2. The 3-candle anatomy. Now the mechanics. A fair value gap forms across 3 candles, and the middle one is the star, a big aggressive body that does most of the work. For a bullish gap, you draw from the high of the first candle up to the low of the third candle. If those 2 wicks don't overlap, the space between them is your zone, and it sits right across the body of that middle candle. For a bearish gap, you flip it from the low of the first candle down to the high of the third. 2 things people get wrong here. First, only those 3 candles matter. Whatever happened 5 bars earlier is irrelevant to the measurement. Don't let a nearby wick talk you into stretching the box. Second, this is time frame agnostic. The same 3 candles work on the 1 minute and on the weekly. What changes is weight, not validity. A gap on the daily has far more orders parked in it than a gap on the 5-minute. So treat higher time frame gaps as your anchors and lower time frame gaps as your timing tools. Part 3. The inside bar trap. This is the part almost nobody teaches, and it's the reason a lot of perfect gap entries get taken out by 2 pips. Sometimes, the first candle of your sequence is an inside bar, a small candle that lives entirely inside the range of the candle before it, the mother candle. When that happens, 3 candles is not enough. You have to step back and read 4. Look at the difference. If you measure from the inside bar, you get a wide, sloppy zone that includes price the market already accepted, so you're placing a limit order in a region that isn't actually inefficient. Measure from the mother candle instead, and the zone shrinks to the part price genuinely skipped. Tighter zone, tighter stop, better risk to reward, and far fewer entries that fill and immediately go against you. Same rule in reverse for bearish sequences. Part 4. Why price always comes back. So why does price bother returning at all? Forget the mystical version. The answer is just human behavior plus resting orders. Picture gold ripping upward on a strong session. A whole crowd of traders watch that move, go without them. What do? They don't chase at the top. They drop a buy limit below, under an order block, under a demand zone, somewhere inside that impulsive range, and they wait for a deep pullback. Multiply that by thousands of accounts, and the gap is no longer empty space. It's a shelf of resting buy orders, a liquidity pool sitting inside an area where the market never properly traded. That combination is exactly what large participants need, a concentration of orders in a thin part of the book. So price gets pulled back into it like a magnet, fills those orders, and then continues with more force than before, because now there's real fuel behind the move. If that clicked for you, a like genuinely helps this channel reach other traders, and it costs you nothing. Right, let's turn the theory into a decision. Part 5. Reading the reaction. Here's where the gap stops being a drawing and starts being information. The moment price enters the zone, it is answering a question for you. If it rejects a sharp wick, an engulfing candle, a clean displacement away from the level, the imbalance has been respected, and the odds favor continuation towards the liquidity resting beyond the last swing. If it drifts straight through the zone with no reaction at all, that's your warning. The gap has failed, and price is far more likely to keep traveling towards the liquidity on the other side. One warning: a reaction is not the same as a pause. A single small candle wobbling inside your box is noise, not a signal. What you want is displacement, a candle that closes with intent back out of the zone, ideally with a small break of structure on a lower time frame to confirm it. Drop to the 5 or 15-minute chart and let the market show you the shift before you commit. That single habit will keep you out of more bad entries than any indicator you'll ever install. Part 6. Mapping a chart top down. Let's put it on a chart. Say we're on cable, the H1, and structure is clearly bearish lower highs, lower lows. Step 1 is patience. I don't mark a single gap until price gives me a valid break of structure. And by valid, I mean a body close beyond the previous major low, not a wick that pokes through and gets rejected. Wicks lie. Bodies commit. Step 2 is direction of reading. In a bearish leg, I scan from the top down. In a bullish leg, from the bottom up. Why? Because you want the gap nearest the origin of the move. The extreme and reading in the direction of the impulse stops you from anchoring on the first thing you notice. On this map, I find 2 gaps. One sits mid-range and price has already traded back through it. The other sits right up at the extreme, completely untouched. So the plan writes itself. The mid-range gap is dead, it's been used. The extreme gap is my area of interest, and I do nothing until price retraces up into it. And that's the hardest part of this whole method. You are waiting for a move that feels wrong. Price rallying against a bearish bias feels like the trend is over. 9 times out of 10, it's just the market going back to collect what it left behind. Part 7. The 4 rules. Rule 1. No trade without a break of structure or a change of character. The gap tells you where. Structure tells you whether. Without a confirmed shift, you're guessing at which direction the imbalance will resolve, and a gapping arranging market is just a colored box. Wait for the market to declare itself first. Rule 2, the one I promised you. Split the leg you're trading with a Fibonacci and look at the 50% line. Everything above it is premium. Everything below is discount. In a bearish market, you only take gaps sitting in premium. In a bullish market, only gaps sitting in discount. That's it. The single filter deletes the entries where you're selling cheap and buying expensive, and for most traders, it does more for the equity curve than any new strategy. Rule 3. Extremes outrank everything else. If you have 3 valid gaps in the same leg, the one closest to the origin of the move, the last one before price took off, carries the most weight. It has the most untouched orders behind it, and it gives you the tightest invalidation. Because if price trades cleanly through the origin of a move, your idea was wrong anyway, and you want to know early. Rule 4. It must be unmitigated. Treat a fair value gap as single use. The first time price enters it, the resting orders get filled. After that, the imbalance has been paid off, and the zone has nothing left to offer. Going back to a gap price has already traded through is like queuing at a cash machine that's already being emptied. Mark it as used and move on to the next one. And notice what happens when you stack all four. A gap that forms after a confirmed break of structure sits in premium, sits at the extreme, and has never been touched. That's not a common setup. You might get a handful a week on a single pair. But that's the point. You're not trying to trade every gap on the chart. You're trying to trade the few that institutions actually left behind. Part 8. Your drill for this week. Don't take my word for any of this. Go and test it. Pick one pair, open the H1, and scroll back through the last 3 months. Every time you find a break of structure, mark the gaps that follow and log 4 columns. Was it premium or discount? Was it at the extreme? Was it already mitigated? And what did price do when it arrived? 20 examples is enough to build real conviction, and you'll spot your own pattern of mistakes faster than any course can tell you. Recap and close. 11:45, 12. Tom Tat and Ket. 11:45, 12. Quick recap. A fair value gap is an imbalance across 3 candles. 4 if an inside bar is involved. Price returns because resting orders make the gap a liquidity pool. The reaction on arrival tells you the next target. And only 4 things make a gap tradable: structure, premium or discount, extreme location, and unmitigated. Get those 4 right, and the pattern finally starts working the way it does in the examples. If this cleared something up, subscribe and turn on the bell, and the next breakdown goes into order blocks and how they pair with everything you've just learned. And tell me in the comments which rule you've been breaking, because I read them all. Not financial advice. Trading carries risk. Manage your risk, 1 to 2% per trade. I'll see you in the next one.